First, I'd like to welcome you all to joining us. I have Andy Parker, myself, who leads the corporate finance team at Cooper Parry, and Ben Rooks. Ben, do you want to introduce yourself?
Thanks, Andy. Welcome, everybody. My name's Ben Rooks. I'm a corporate finance partner and colleague of Andy's, working at Cooper Parry, the UK member firm of Global M&A.
We thought we'd start by just looking backwards at the global financial crisis and seeing what parallels can be drawn from that. Clearly, that was a time when the market had a massive dip, generally across the UK and frankly across the world. And I suppose what I saw at that time was that there was a massive slowdown of the larger deals, the mega deals, the international deals. But even though in reduced volume, the mid-market deals, the businesses backed by entrepreneurs continued to happen. And I described at the time that it was effectively some of those trigger events, those events in people's lives that happen, and entrepreneurs as businessmen, as individuals, they impact them. So it's births, deaths, marriages, divorces, make people rethink their business. And during that time, deals did continue, albeit at a slower rate. And business, interestingly, that some of the investments that were made during that period, particularly by private equity, proved to be highly successful returns and deliver really strong returns for the PE houses thereafter. I worked on a number of deals, whether it was for management on deals like Advanced Childcare or Brand Addition, or with the private equity house on something like Clark Energy, where the price that was able to pay on the way in was, frankly, more attractive than it would have been a couple of years before. But on exit, because they were good businesses, good management teams, but also the market had pushed up. So the returns were really, really strong all around.
We thought it would be useful to put into context what you're saying here and just illustrate it in terms of what happened, both in terms of deal volumes and values, both pre and post the global financial crisis. So if you have a look at 2007, for example, that was a bumper year in the M&A world. Just under 5,000 transactions at a combined value of around 650 billion. So pretty stellar in terms of the market at that point. What you then start to see is the market drops off a little bit. So 2008 deal volumes down to around 4,000. We have Lehman's in September 2008, and we really see a drop off then in 2009 where deal volumes drop below kind of 3,000 for the first time in a long time. What you then start to see between kind of 2010 to around 2013, things pick up slightly and remain pretty steady in terms of transaction volumes, hovering at around about 3,500 transactions. And then from 14 onwards, kind of through to 2019, those number of transactions have actually picked up. One of the interesting bits from a mid-market perspective, though, you can really see the drop in terms of the total value of the transactions in each of those years. So that comes down dramatically. We talked about 650 billion in 2007. That drops then significantly. And if you then start to look at 2009 through to 13, you'll see that the overall value of those transactions has dropped significantly, which is what we saw in terms of mid-market deals. So those in the lower mid-market, let's say the 10 to 100 million space, a lot of those deals still continue to happen. The real effects were seen in the multi-billion pound transactions where there just weren't many of those kind of closing. We suspect that post this COVID-19 crisis, that might be a similar trajectory of how things go.
Okay, but Ben, so when the COVID-19 crisis pandemic is over, what type of deals do you think will still be attractive at that time?
Sure. So I think there'll be a number of opportunities that come out of this. Clearly, I think we've got to come out of lockdown for lots of deals to still happen, and the soundings that we're taking from our private equity client base and business private equity firms that we know well is that they can progress things so far, but ultimately they want to meet kind of management teams. So running a totally virtual process, I think, gets you so far, but ultimately they will need to meet the team to get comfortable with the investment decision. So that's one facet. But I guess the characteristics of things where we think there will be transactions, PE will be a big area. So there's lots of funds that have been raised over the last few years. There's lots of private equity dry powder out there, and we see both from private equity platform businesses making bolt-ons to their existing platforms. So either taking them into new markets, giving them new services, adding technology, increasing market share. We think that will be one facet of the market, and clearly with them being comfortable already with the platforms that they're invested in and knowing that market, I think that's an easier ask for them. The other side of that, though, is that inevitably, I think they won't sit on the sidelines in terms of new areas to invest in. They're incentivized to put money to work. So we do see a number of kind of new areas that private equity might go into. And what do we think those transactions could be? From a business owner perspective, and we've seen this a lot, not just kind of post GFC, but over the last couple of years, where business owners have decided to take a business so far and then actually take some cash off the table and crystallize some value. So you give up some equity in your business, you bank some at that point, de-risk, and then you go again. And clearly the ambition there is kind of each time you're banking more money than you did in the first. So those kind of de-risking transactions we think will be a feature.
I'll back you up on that, Ben. I think from my experience of talking to people at the moment, that whole thing of taking some risk, they've seen two massive events happen in the last decade with the global financial crisis and then this, taking some money off the shelf and locking it away will enable them to move probably even faster going forward. And I think we've seen the ability, perhaps taking private equity on board, it gives you the firepower to then do the bolt-on acquisitions, which might become, as you've said, more available in a situation post-COVID.
And I think that's right. I think a big feature for businesses, and the quickest way to change things for them is by making kind of acquisitions. So those businesses that have got equity ready to invest, to take advantage of opportunities, either that are stressed or that need to happen in a timely fashion, I think those businesses will be better positioned to prosper. I know we've seen it, and certainly from an advisor perspective where we sit, we look very favorably at businesses in processes that we know have equity firepower, because clearly they may still want some debt in their structure, but a lot of the time the equity can get them quite far in terms of being able to make that acquisition. So it's a big tick from an advisor perspective when we are thinking about favourable candidates and processes. I guess the other area where we also see opportunities as well, and this could be for listed businesses or larger corporates, we think that some of those will either look to sell off some non-core assets, or there may be opportunities there because the businesses have taken a little bit of a hit in terms of their valuation. So is there an opportunity to take out divisions or assets within those sectors? PE will clearly be looking at those kind of areas as well. And that could also be attractive to corporates that are looking to sell, because there is a certain amount of leverage in those businesses, so they may be able to pay off some debt. Ultimately, for PLCs, it's about returning money to their shareholders. So it could be a strategy of getting money back to shareholders over a medium to longer term basis if they can sort their house out.
I think that's a really good point, Ben. And I suppose the other factor for those larger businesses is, with all of the new complexity that managing a world post-COVID is going to have, actually decomplicating their businesses by selling bits off as well, probably good strategically for them as well as financially. Yeah. Okay, so look, I agree, Ben. And in the post-COVID world, what sectors do you think the M&A activity will focus upon?
Sure. So I think it's probably easier. Let me talk about some of the characteristics that I think will be attractive, and then I'll relay those back into kind of sectors where I think there will be activity. So what will make kind of businesses attractive post the COVID kind of crisis? So those businesses that have visibility of their revenue and profits. So ideally from a contractual nature. So those that have underpinned profits and revenue will clearly be attractive, and I think that goes across a number of sectors. You then have businesses where there are regulatory drivers that mean something's going to happen, and they are well positioned because of their knowledge of the space and the market they are servicing. Those businesses will continue to be attractive. The world, we think, has changed a little bit post the COVID-19 crisis, how people work. We've seen it with adopting things like Teams and Zoom a lot, and virtual meetings happening. Technology is going to play a big factor into, I guess, how businesses perform in the future. And those that have embraced technology or are doing something unique in terms of technology clearly are going to be really well positioned to take advantage of the new way of working, the new post-world COVID. So where are we thinking there are opportunities, and where will we be spending most of our time? Healthcare has lots of those features that we talked about. Lots of positive regulatory drivers. The demand for a lot of businesses has continued. So we see opportunities both in health and social care. So medical products, pharma services, a lot of aspects of social care. We think there will be deal activity, and it's a relatively safe place to invest compared to some sectors. So technology is clearly going to be a big area. So those SaaS model businesses, they were attractive pre-COVID. I think there'll be a real kind of rise of some of those, and we would expect multiples to be very frothy for good technology businesses. And then the other area we see lots of activity as well, it's the business services space. So those businesses, again, that have a technology angle to them. So tech-enabled business services is another area where we see lots. Clearly areas like consumer, leisure, entertainment, there are still some good businesses in there. I would have thought the ones that can prosper are those that have embraced e-commerce, but clearly those sectors have got some challenges in the short term, short to medium term.
Interesting, you said about some frothy multiples maybe in some of the technology areas. What generally, when we look across the deals that will happen, how do you see deal pricing going to happen in this post-COVID world, and what about sources of funding?
Yeah, okay. So I guess what's important to remember here is this is a health crisis and not a financial crisis like we saw back in 2008. So we're in a very different place kind of entering into this, and you do have to get back to, this is a virus that's caused that, and that's clearly kind of impacted on business. But in the short term, what plays into pricing? So those characteristics that I just talked about in terms of what makes businesses attractive. But another component is clearly leverage. So a lot of private equity deals have been built on the basis of getting a certain amount of debt into transactions. What we are hearing from transactions that we are seeing and our conversations with the debt market, that what we would term the high street banks, the names that you would recognise in the UK, have very much entrenched to focusing on their portfolio and some of these government support schemes. So new business with those banks is more challenging, and they are run off their feet at the moment with the government support initiatives that have been implemented in the UK. This has given an opportunity for some what we would term challenger banks. So the next tier down of banks that are less well established but are growing market share. So a lot of those are seeing it as an appetite, have appetite to build some market share at this time while the high street banks are retrenched. I think inevitably you're going to see less leverage in the short term in the market. I mean, if you go back to the global financial crisis, the leverage levels were extremely high. So pricing for the last couple of years has been frothy, but it hasn't been built so much on excessive leverage where, you know, we were hearing about businesses that were 6 to 8 times leveraged back in the global financial crisis. Most of the businesses today haven't got that level of leverage, but certainly short term, getting debt into a transaction, we think will be slightly harder. So not impossible, but at more modest levels. But this we think is kind of short term. But because of the risk of deploying debt capital at the moment, it's likely to come at extra cost in terms of margin. So that's certainly that. So it's really hard to predict actually what's going to happen in terms of business valuations. Good businesses will still go for great valuations, particularly in the sectors that we've already discussed. Short term, yes, we can see an impact, and you know there is a risk of deploying both equity and debt capital, but longer term, the banks are in a better place. We expect leverage to be able to bounce back, and it's not like we need it to bounce back to GFC levels.
Yeah, I'll echo a lot of what you've said there, Ben. And perhaps the thing that I remember very clearly from post-global financial crisis, the last massive dip of this nature, was that quality businesses still went for very good prices. If they're a good, strong business, resilient business model, great management team, they're going to be in demand. And as you said, this is slightly different from then. The funding is still there this time around. The money is there. Private equity have got money. Banks, albeit going to put in lower leverage than perhaps before this crisis, have still got money. So the demand for those good businesses with strong management teams and resilient through this process is going to be high.
Yeah, and I guess what we're also hearing from the market as well, some of those investors, and this may be the same kind of worldwide. So some of the private equity investors have the ability to certainly write both the debt and the equity for a period of time. So it's not a long-term investing model, but to kind of see them through to get good businesses, deals done in those spaces. They will look to write the whole check and then refinance the debt later. So that is certainly being talked about as a facet of the market, and in our processes that we're looking at, we will definitely be looking at private equity houses that are prepared to do both, because it just means, from an advisor perspective, certainty of a transaction is increased significantly under that scenario.
Yeah. So I guess if we would try and summarize all of this, I guess what I'm taking from what you're saying, Ben, and what we're seeing is in the post-COVID world, we're going to have continued interest in really good quality businesses. There's going to be an opportunity for entrepreneurs to de-risk, take some money out of the tables, off the table, so that they're secure in their personal wealth future, but can still grow their businesses. We know that there's private equity there still really very keen to invest, and we haven't got the constraints that we had of the global financial crisis on debt levels. So there's debt funds and debt and banks still there with money, albeit it might be a lower level. And then with all of that, we've got the sector focus on key sectors which remain resilient, have good, strong fundamental drivers in technology, in demographics, in regulation, and so on, that will continue to be attractive. And that in those areas, we'll see deals. We may see fewer global international mega deals, but we might see some of those big companies actually sell pieces off as well. Is that a fair?
I think all of that resonates, Andy. So I think you've hit the nail on the head there. There will still be opportunities kind of out of this, and those businesses, I guess, that we see that will probably prosper the most are those that are already thinking about what the future looks like and how they are going to get themselves kind of geared up to take advantage of the opportunities that are available.
No, I think that's a really good point. Thinking well in advance and planning, even in the midst of a crisis, sits you in a good position for afterwards.
Absolutely.
Well, thank you very much, Ben, for your thoughts on the marketplace. Please do feel free to contact either Ben or myself if you want any more discussion on this.
Thanks, Andy.